Uh, okay. Hi all. Thanks for joining us. Good evening, everyone, and a very warm welcome to you all. Thank you for taking the time to join us today for the SMSF Property Masterclass. Build long-term wealth with your super. Whether you are joining us from Sydney, Melbourne, Brisbane, or anywhere across Australia, we truly appreciate you being here. Now, before we begin, just a quick check. Can everyone hear me clearly? I'll just see the. Yep, correct. That's good. I think people can hear me. Perfect. So, my name is Anita Kumar, and I am the co-founder of ANP Buyers Agency. Along with me today is Pratiksha Kumari, and we also have Danush, who will be sharing insight from the lending and SMSF perspective. Between us, we have been actively investing in property for many years. So, not just advising client, but actually building our own portfolios through market cycles, mistakes, and learnings. And that's exactly why this uh, session is going to be a little bit different. This is not going to be sales pitch, and it is definitely not going to be high level theory, which you can look at Google later on. Instead, we are going to break down how SMSL property actually works in real life, what most people get wrong, and how to use super strategically to build long term wealth. Because here is the reality: most working professionals today are sitting on the growing super balance, but they don't fully understand how powerful it can be. And at the same time, many people are investing outside super, while their largest pool of money is just sitting idle. So today's goal is to give you clarity, give you confidence, and most importantly, give you clear strategy you can actually use. Now, just one thing before we dive in, this session is designed to be interactive. So if you have any question at any point, please feel free to drop them in the chat and we will make sure to address them towards the end. All right, so let's get started and show you how your super can become one of your strongest wealth building tools. Before we dive in, just a disclaimer that what we are going to cover, and just as importantly, how to interpret what you hear today. First, quick but important note: we are going to share real strategies, real numbers, and the real case studies. But everyone's financial situation is different, so anything we discuss today should always be considered alongside with the advice of your financial planner, SMSF accountant, and the solicitor. Our goal here is simple: to help you understand the opportunity, to help you avoid the common mistakes, and to help you think strategically about your super. It's not to give one size fit advice for all. So now let's talk about what you're going to get out of today. We have structured this uh, session very intentionally. First, we will talk about why SMSF is gathering so much momentum right now, especially in 2026 and beyond, because timing matters. And we will break down how property actually works inside super, not theory, but the practical structure, lending, and what you can and can't do. After that, we'll get into the real numbers because at the end of the day, property is not about emotion, it's about the math. And show you how growth and cash flow actually play out over time. Then something very important which most of the people skip, it is the risk. Not the generic ones, but the real risk we have seen the client face and how to avoid them. We will also walk you through the real client case studies so you can see how this works in real life, not just on slides. And finally, this strategy makes sense for you. We will show you how we help clients actually execute it step by step. So by end of this this session today, you will have a very clear understanding of whether SMSF property is right for you, what it really takes to do it properly, and how to move forward with confidence. All right, so let's get into this. Okay, so for whom this today's webinar is for. So if you are a salaried professional earning good income and you have been building your super over time, but you feel like my money is not growing, but not my money is growing, but not really working hard for me, then this is a highly relevant for you, especially if you combine super, if your combined super is around 150K or more, because that's where things start to become more like you can purchase property and it can be like become more uh, strategy based. Otherwise, if you're a business owner or self-employed, you already understand the leverage, you already understand the control, but most important, business owners don't realize they can structure their super the same strategic way. In fact, a significant portion of SMSF in Australia are actually run by the business owners because they want control over where their money goes. So now this is a big one. If your super is sitting in the managed fund and earning roughly 5 to 7%, and you have no visibility where it is invested, what assets you own, or how actually it's growing, then you're not alone. But you do have options to take more control. And it is also for the couple. So if you are a couple, this becomes even more powerful because when you combine the super balances, your buying power increases significantly. Your costs get shared and your strategy becomes stronger. We have seen many couples who individually couldn't do much, but together were able to enter the property market inside super confidently. So you are sitting here thinking that actually sounds like me, then you are in the exact right place today. Okay, so we have looked like what are the benefits of super. Let's see what is the problem with traditional super. Your super on paper, it's growing, contributions are going, and it feels like things are working for you. But the real question is that do you actually control it? And for most people, the honest answer is not really. Now, let's look at the point one, which is the return. Most managed super funds average around 5 to 7% over time. Now, that might sound okay, but when you factor in inflation, taxes, and time, that actually is quite mediocre growth. And most importantly, you are fully exposed to market ups and downs without any real control over it. Now, the point number two is transparency. Like most of the people, they don't realize, you don't even know that where your money is actually invested. It's spread across various funds portfolios structured, but there is no real visibility, no direct ownership, no clear strategy you are driving. You are essentially outsourcing one of your biggest financial assets, and you don't even have transparency on that. Then comes the fees. Even with 1% or 2% per year might sound not like much, but over 20, 30 years, it compounds and it eats into your wealth significantly. And the biggest problem is you don't even feel it, but it's always there working against you. And this is the interesting one, that there is a no leverage or control. So, and this is the biggest limitation of the traditional super. Inside traditional super, you can't leverage property or properly. You don't own tangible assets like property, and you have very limited control over your plans or your strategy. So while your money is growing, it's not necessarily growing in the most strategic way. So when you put all of this together, so like the average returns, low visibility, ongoing fees, and no real control, you start to see the real issue. It's not that super is bad. It's that most people are using it passively instead of strategically. And that's exactly where SMSF changes the game. Because the goal is not just to have super, the goal is to make super work for you. Okay, so what is SMSF? Let's make it simple because when people hear SMSF, it sounds quite complicated, but in reality, it's actually very straightforward. SMSF simply stands for Self-Managed Super Fund, which means instead of someone else managing your super, you take control of it. So you can think of it like this: your super doesn't change. It's still your retirement money, it still has the same tax benefit, it's still regulated. The only thing that changes is who makes the who takes the action. Okay, and it is in SMS. In SMSF, it is you. So, and if we see, so in SMSF, you are the trustee, which means you have full legal control over the super fund, not the bank or the fund manager. You choose the investment, and this is where it becomes powerful. You can invest in property, in shares, or in cash based upon your strategy, not the generic uh, fund manager. It is regulated, and this is important to understand. SMSF are fully regulated by ATO, audited every year, strict compliance rules. So it's not for free for all. It's structured and compliant. And the tax benefit remains the same. So like 15% tax going in, 15% on earning, and 0% pension in the pension phase. So you're not losing any advantages. You are just gaining the control over your money. And if we compare, so let's see. So instead of average managed fund returns, which is the traditional super, you get target stronger strategy driven growth. Instead of market linked paper assets, you can own a real tangible asset like property. Instead of no visibility, you have full clarity of what you own. Instead of no leverage, you can actually borrow inside your super to amplify your position. And most importantly, instead of someone else controlling your money, you are in control. So SMS is not SMSF is not about doing something risky. It's about doing something more intentional and strategic. And when structured properly, it allows the super to move from passive growth to active wealth creation. And one of the most powerful way people use SMSF today is through buying property. Now, this is where things start to get really interesting. Because once you understand SMSF, the next natural question is, what should I actually invest in? And one of the most powerful strategies we see is the property inside super. So let me break down this how it works. So capital growth. First, like this is the thing which I like most. So over the long term, Australian residential property has historically grown around 6 to 8% every year. Now, the key difference here is your SMSF owns the asset directly. So instead of being part of the pooled fund, you are holding the real appreciating asset and capturing all of that upside. And over 10, 15, and 20 years, the compounding become effective and it becomes very powerful. You get the rental advantage if you buy property. Now, let's look at income. When the property generates rent inside your SMSF, that income is typically taxed at just 15% compared to your personal income, which would be taxed as high as you can say 45 to 47%, like depending upon individual income. That's a massive structural advantage because more of your income stays inside your super fund and continues to compound over time. So this is one of the biggest advantage. And let's talk about the leverage power. Now, this is where things become even more powerful. Inside SMSF, you can use something called as LRBA, Limited Recourse Borrowing Arrangement, which Danush, after our session, will walk through that. So, in simple terms, it allows your super to borrow and invest in property. So, for example, so if you have 200K in super, you can potentially control asset of 600K, even more, because now we get 80% loan, and so which is three or three and a half or four times uh, the buying power you get. So, and here is the key: your growth is happening on the full asset value, not just on the initial amount. So, I will show you example of this one. So now let's layer the tax benefits: the rental income tax at 15%, capital gain tax at 10% if held for long term, and in retirement 0%. Just pause for a moment and think about that. You are building an asset which is growing over time, generating income, and potentially paying zero tax in retirement. So when you combine everything together, the capital growth, the rental income, the leverage, and the tax efficiency, you start seeing why property inside SMSF is not just an investment, it's a wealth building strategy. But like any powerful strategy, it has to be done the right way, and that's where most people get it wrong. So, this is the same thing which I spoke in the earlier screen, that if your super has 200K, you can purchase the property, say, worth 600K. So the growth is happening on the higher amount now. So let me give you one example, and let's compare SMSF, the property versus shares. Okay, and let's take everything we went through and put that into the real numbers, because at the end of the day, strategy will matter only when the numbers will make sense. So what I'm going to show you is very simple here. Same starting money, two different approaches, a very different outcome. So let's start the scenario. Let's assume you have 120 in your super. Now you have two choices: leave it in shares or super management fund, or option two, use it as a deposit inside your SMSF property. So option one, the shares. So let's say the average return is 8% per year. After 5 years, you get around roughly 160K. After 10 years, 259. Now, that's not bad. Your money is growing and the compounding is working. But the key point is that the growth is only happening on your deposit money, which was in this example 120K. Option number two, you buy property inside SMSF. Now look at the same deposit amount, 120K. Instead of putting it into a share, use it as a 20% deposit to purchase 600K property. Now your SMSF controls 600K asset, so not just 120K. And assuming the same 8% growth, after 5 years, your equity grows to around 400K plus. After 10, it would be 800K plus. So now pause for the moment. Same starting point, same growth rate, but completely different outcome. So you can look at the graph now where with the same amount where a person can go after like few years. And you can see that the shared line grows steadily, but the property line accelerates much faster over time. And this gap keeps widening as the time goes. So, this is the key takeaway. It's not just about what you invest in, it's about how you structure your investment, because the right structure can multiply your outcome without increasing your starting capital. But this works only when property is selected correctly and structure is set up properly. I will pass it on to Pratiksha now, and she will show you some real examples, real properties which we purchased for our client to see how it works.
Hey everyone, so that was a good knowledge from Anita. And now we will see in real time what we have bought so far um, in SMSF for our clients. So one slide back. Yeah, just slide number 9. Yeah. So just to fit in this 1 hour, and we have right now how many properties. So it's it's not shared.
Is it better?
No, no, it's not. The screen is different screen.
Sorry.
Screen shared is different screen.
Okay.
Yeah, yeah,
Yeah.
yeah. So in the presenter view.
Yeah.
Yeah. So these are the number of properties we have bought last year in SMSF. So you can see it's spread around the country. We follow the market cycle where exactly the property prices are about to go up. And you can easily see that in 1 year, how much equity has the property has gained. So once I review this slide with you, I'll go into individual property. So the first property we bought, that was a 1 year ago, bought for 527. Right now, the valuation of that property is 600,000. Maybe I can share my screen and one by one show the property. That will be good. Uh, yeah, yeah. So this is the first property we bought, and that was about 1 year ago. The purchase price was approximately 527, so we negotiated well on that property. And as if you see, it's in Melton area, just 1 hour away from Melbourne CBD. So till last year, we could get properties in 500,000, and we followed the market cycle, and that was a good time to enter in Melton. So property is a brick house, 1980 build, renovated from inside, and at that time we could secure 480 per week rent, and right now the valuation of the property is sitting above 600. So this is the type of property you can buy in SMSF, and with this type of numbers, the property cash flow, it gives you a like a good out of pocket expense, approximately 1,000 to 1,500. This is the another property we bought in Cairns area in Edmonton suburb, 2008 built. We bought this for 645. The current valuation is 750 for this property. When we bought the property, it was rented for 680 per week. So I was talking to the investor last month, and this property is now close to neutral for him. So there are no out-of-pocket expenses at the moment. Yeah, so I'll just go through the property with you. Uh, yeah, yeah. Moving on to the other one. This one is a renovated house. The pictures doesn't look like that. And we bought off market, so there was a lot of work done to this property. This is a house with a granny flat, 12-month-old granny flat. So we bought this for 650,000 and a rent of 870. Now, with most of the property we have bought for our clients, the property goes on rent before it's settled. So it might not be the right pictures for this one, but this was also 100% renovated from inside. So as you can see, the property is close to neutral or maybe positive in a couple of years. Yeah, this is how is the renovated house looks like. Okay, so we're still surprised with the growth we're seeing in Western Australia with the couple of purchases we did last week. So this was on market property. We bought this for 750. The rent, we could secure the rent of 700. Right now, the valuation of this property is close to 900. I think it's more than 900. If I look at the valuation, it's close to 950 at the moment. So this was settled sometime in October. This is the contract exchange price. Five-bedroom house in Yanchep area of Western Australia, very close to beach. So what we see is in future, this should be a good investment for our client. So yeah. Moving on to the next one, which is in Secret Harbor. Again, in Western Australia, bought for, so yeah, this is the valuation, current valuation, 937. There is nothing in Secret Harbor now below 900. That one we bought for approximately 770K. Um, and if you look at the property, it's approximately 2006 or 2008 built, so very well and very nicely maintained from inside. Yeah, moving on to this one. This one is in again in SMSF. Um, so this one is in is close to Rockhampton area in Yapoon side. This one we bought for 772,000. The current valuation is sitting approximately, I think there's nothing for 800 anymore in that. And I can tell you this data is slightly behind. Um, and so we bought this for 770 and could secure the rent of 820. So which is quite good rent compared to what is being invested. And again, it's a beautiful property for long-term buy and hold, very close to beach again. So that again tells that in future the values can go up. This one again, this one is in Dubbo. And we all know that Dubbo is going through a big transformation. There's lots of houses about to be built in couple of years. So this is only 4-year-old property built in 2020. This was a really nice uh, uh, a nice buy for SMSF, good for long-term buy and hold. Bought for 720, already rented for 650,000. Yeah. So the current valuation is approximately 765,000. So it's not even 3 months since we have bought this property and it's done good. This one again in Hidden Valley, which is in Yapoon area near Rockhampton. Very, very low supply market. Uh, Not enough stock available. So this property is again 2006 or 2008. Bought for 722. It was already rented at that time for 700 per week. So yeah, no rent gap for our clients. So again, a beautiful property with a big land size as well. This one is we bought this in Western Australia, entered at the right time. So when we're buying property, the good thing is to buy something which is on the lease, because when the properties are on lease, no owner occupier can buy this property. And these locations are owner occupier locations. So you get a good resale value when you resell it. But because it was in 12 months lease, we could secure this at the right price, like 765, and the current valuation is as just 6 months ago. We just bought this 6 months ago. Current valuation is sitting at 917. So we'll just stop sharing for a moment so that I can go back to the slide. Yeah, I think we don't have much remaining in this slide. Let me just cover a couple things. Yeah, Anita, could you share that slide again?
Yeah, I'll share you. Yep.
Yep. So um, I'll just quickly go into that. Like you can buy all these type of houses. Definitely house and land package you need a single contract to buy, which is very, very hard to find, but not impossible. But yeah, established homes, dual income properties, perfect to buy in SMSF. We'll keep the loan part for Danush. So yeah, next slide, please. Um, yeah, so basically for SMSF, buying the right asset is very, very important, especially your out-of-pocket expenses, because out-of-pocket should be paid from your yearly SMSF contribution. That is a good strategy to have. And most of the buyers we have bought, the out of pocket is approximately 1,000 to 1,500 per month. So that works really well, because most of the people have approximately 1,500 as monthly contribution coming to their SMSF. So that's really good for a couple of years when the property is negatively geared. But after a couple of years, yes, it becomes close to neutral. Yeah. So next slide, please. So to find the right property, there's not like a lot of big secrets. There are only a couple of things which you have to follow when you're buying in for SMSF. Now, as for SMSF, most of the people wants to buy this and hold for a long time. So uh, though we follow the market cycle, the best approach will be to buy in a high capital growth area, which ticks all the boxes for growth fundamental, right? Even though, say, for example, the market is at the moment flat, but if it has got right population, all the infrastructure projects lined up, and a supply shortage, those types of areas ticks the boxes for a good growth for your SMSF property. And like whatever properties I have shown, we have made sure it meets all these criteria. So and apart from that, definitely risk filters, which you should always check, like flood zones, and any major easement running in the property. So those type of things can impact your resale value. So if all these things are followed, especially the growth corridors, infrastructure driven demand, and supply shortages, the properties, yeah, the SMSF property will definitely have a good growth. Um, yep, I think that's all from my side. I'll just hand over to Danush. Yep, this Anita has already covered that, how much you can expect to gain when you start with 600K property, super balance of 180. And so based on the numbers and the properties I've shown, you will be close to uh, like small negative gearing or near neutral from year one or two. And 457K of capital growth in 10 years. That's the uh, power of compounding. So yeah, I'll hand over to Danish.
Thank you, Pratiksha. Thank you, Anita. That was very insightful. So yeah, I'll be going through a couple of things, right? Firstly, how it works in terms of the eyes of the bank, right? And then secondly, we've been doing SMSF for quite a long time. And then I want to present some live scenarios or talk about live examples. And personally, what I think about SMSF being on the ground, dealing with clients who invest in properties through SMSF, right? So when it comes to SMSF lending, you've covered most part of it in terms of structure. But with a very layman's view, right? Banks are very smart in the way they want the SMSF loans to be structured, basically, right? So the borrowing power that we do, or the bank's, calculators function will be equivalent of the rental income plus super contribution, right? So if a person is salaried, their super contribution plus the rental income will have to cover the mortgage pretty much, and have a little bit of more excess. So that's how the lending is designed. So there will be no out of pocket expense as long as the property is not vacant. That's where clients needs to work with, professionals like you to get a property that will, have less chances of going on, vacancy, right? So that's with regards to lending, right? Now, in terms of structure, we want, obviously the SMSF to be set up through an accountant, right? Once that's done, the bank will usually place in for a pre-approval. And once the pre-approval is provided by the bank, is when a bare trust can be set up. So bare trust is not needed to be set up prior to pre-approval, right? Because bare trust is only needed if you're going for a loan, right? So that's in terms of lending. And then the property always has to be an investment property, right? And the second thing is it needs to have a single contract. So land and house packages is very hard. We have seen very, very few scenarios. Only, off the plan completed properties, people go in for SMSF, but it has to be single contract once the property is completed, right? So that's with regards to lending, right? And then coming to banks, the majors are out of it, right? We do have one of the second tier lender that's come back into market in terms of AMP, who is starting to lend for super. And the second part is it's mostly done by second tier lenders like Granite, First Mac. So these are the lenders that usually lend for SMSF. And each individual case is different. So we make sure banks fight for your business and try to get the best rate when, when we're trying to get a pre-approval. So that's in terms of lenders. But what we always advise is not a financial advice, but generally a good thumb rule that people follow is when you're transitioning from a super fund, which is industry super fund, to self-managed super fund, right? Usually people leave a balance out to continue with their health insurance or to continue with their life policy insurances, right? So that's usually cheaper through industry funds. So people leave a small, tiny bit just to make sure their industry fund is still active and their insurances are still active. They do leave out about 10, 15,000. It depends on each industry fund as to how much minimum that they need to leave. So the remaining can be pushed over to self-managed super fund to purchase a property. Usually what we see in the current scenario, 150K combined balance is good enough to purchase a property worth 600,000, provided, both the applicants are employed, right? So the borrowing part works again on two concepts. One is the rental income. The second one is the super contribution that happens. Now, those two needs to be tied up to your super balance. For example, you might be earning 200K each, which is 400K per couple, but your super balance might be very low. You might have just come to Australia a year ago, right? So your borrowing power in terms of, your income, which is super contribution and prospective rental property might be very high, but because you do not have that base, we will not be able to, fund that because basically banks will lend only 80%. 20% needs to come, 20% plus stamp duty needs to come from your super balance. So if you're purchasing a property worth 600, which is 20% of that is 120,000. So 120,000 plus stamp duty should come from your super balance, which is usually around 150K, right? And if you work with your accountant, they will always tell you you will have a bit of space to push in a bit more super for your previous year's contribution, right? So that's with salaried people. And people who are self-employed, it's the same, but the documents that we need will slightly differ. For a salaried person, it's very simple, which is payslip. But for self-employed or business owners, we will need tax returns, right, to prove the last 2 years. Again, work with us, work with accountants to see, what options we have in terms of, because not every self-employed, not every business owner would be paying super to themselves, right? But there's always options to work around it. Right. To give you an example, we can tell banks that, previous year profits will be used towards super going forward. They might have not contributed last year, but they are going to contribute towards super after they purchase a property. And bank just needs to see a profit there, to make sure, that there is sufficient amount that's needed towards that can go back towards super contribution on their financials. So that's in terms of lending. And when it comes to, you spoke about quite a bit about leverage, right? And that's my favorite topic when it comes to SMSF as well. So what we see is um, an industry fund might perform superior, right? Might do well in terms of, I'm not a financial advisor to give that advice, but I'm just talking in terms of what we see on the ground. And nothing speaks better than live examples in that we have seen in terms of customers who've SMSF is there in the news from last 3 4 years, but some smart investors have done that, a decade ago. And the live example is there to see, because industry fund, is also there from last 10 15 years with our customers. And there are people who have also done, SMSF property investing. So when it comes to industry fund, it can grow, based on market, lower or higher. That's completely left to industry fund, right? Now, when it comes to SMSF, an individual is also allowed to invest in certain other investments other than property. Correct. So, for example, capital markets, a lot of people do development finance, right? Different source of revenue that can give them that can increase their industry fund. Basically, you don't have control, but as soon as it comes to SMSF, you have control. And with that funds, you could do a lot more things other than property as well. But the biggest advantage that property brings is nobody else lends for anything else other than property. If you want to invest in shares, or if you want to invest in capital market or growth markets, there is no lending that's coming from banks, right? So your base of investment will always remain how much your super fund balance is. But as soon as you invest in a property, let's say with a $150,000 of your super fund, you're purchasing a property worth 600,000, right? Or even slightly lower, 580. Just for argument's sake, let's keep it, 550, right? And you're getting a rental return of close to $400, which is very low. I ideally expect it to be slightly more than that, but let's keep it, worst case scenario, right? So even if the rental is around $400, what banks assume, banks always assumes worst case scenario. So when they fix in your borrowing power, they assume the rental will remain stagnant, and they assume your income will remain stagnant, because they don't have any evidences of, growth in future. So they will not assume growth or rental increase, even though it's customary and it always happens due to inflation, right? But in reality, what happens is your rental income, increases due to inflation. Yes, there might be times where rental, will also go down. We have seen that, in Australia the last few years in certain pockets, but generally it always catches up and it's always on an increasing trend, right? And your salary, again, even without, you know, um, things like, promotion or anything like that, just the wage growth that happens, right? Very basic wage growth, your super contribution also will increase, right? So both of those, because it's tied up to super, your super contribution keeps increasing because your salary keeps increasing. Your rent, due to inflation, right? And especially if they're using a buyer's agent, it's always expected to go up. And rent will also increase due to inflation, which usually in an investment property, a client can use it, right? If it's in their personal name. But because it's in self-managed super fund, it's tied to self-managed super fund. So your super contribution, your employer will stop making it to industry fund. It will start going into self-managed super fund. And your rent will also go into self-managed super fund, which you can't pretty much use it until you retire, right? So what do most people do? Put it in their offset account, right? So rental is increasing, um, and super contribution is increasing, which banks don't usually take it into consideration when they give you a 30-year mortgage, right? So because of these two factors, a loan amount of 450K initially in 10 years time, right, would our modeling shows based on real numbers would come down to close to 160 to $180,000, just based on average inflation, average productivity growth in wage, right? And the property usually in 10 years, like you showed a lot of examples by the looks of it, the properties are doubling in 5 to 6 years. But again, I'm keeping a worst case scenario, right? 10 years, right? In 10 years, if the property doubles from 500K to $1 million, your your loan amount is around 160K in 10 years time, right? So you've built equity or wealth of 850,000, which is impossible for your industry fund, even if it grows at 12%. That's basically the magic of compounding, magic of leverage. You're using bank money to create wealth for your retirement, right? And with the super fund, as and when your super balance increases again, because naturally we've assumed worst case scenario here, right? Which is very minimal rental growth, but rental can excessively grow in certain periods. And again, if your super contribution also increases, right, over a period of time, um, an extra pooled amount of SMSF can be used towards another purchase, which people usually do in about 7 years' time. If you don't do the second purchase as well, just putting the funds again in the offset account, right, will again eat up a lot of interest that you ideally paid to banks, naturally creating wealth there using banks' money. So yeah, there are, again, this is not a financial advice. It's just coming from live examples on the ground that people, have made with these decisions. That's basically because your asset base is growing on a bigger, larger number. The larger the number is, it's better. Most people purchase, properties somewhere between 650 to 850 based on, the demographics that we are talking to, who are usually in Australia in the last 10 years. They're in IT, couple working average salary of 150,000, right? Their balance is usually around 200K mark, which will enable them to purchase a property worth 750,000, right? After accounting for all the buffers. So 750K thousand in 10 years, 12 years, you're looking at a $1.5 million property. And a lot of people ask, how can a $750,000 property go up to 1.5 million? Our usual answer is just look at the property prices 10 years ago, right? Even then, $1 million seemed very, very expensive in Sydney today. It's around 2 million mark, average price around 1.5 million mark. So yeah, it's definitely the power of compounding and leverage that we have seen in terms of super. And finally, to conclude in terms of lending, it's not standard. Um, it has slightly little bit of more paperwork, but if you work with right mortgage brokers, they should have an ecosystem around them, right? Which is having accountants that would just do super SMSF setup, buyer's agent that are capable of finding properties for that price, and very, very important to make sure the vacancy is as low as possible when customers purchase. Again, that's your domain, but that's the only risk that bank sees as lenders, right? What if a property goes for vacant? Because banks, when they do this, they are not considering your gross income or your existing liabilities into picture. So they are highly relying on two things, which is your super contribution, right, and your rental income. for servicing. So because it's done under a trust structure, the other advantage of SMSF is that this will not impact your personal borrowing power at all, because banks are not using your personal income for servicing. So it does not really affect your borrowing power as such. So it's a win-win for a lot of things. Anita, that's it from my end, unless you have any questions or someone else has any questions.
Yeah, and there's one more thing. There's kind of a lot of myths about SMSF that it's complicated. It takes a lot of time. I would like to share one of our buyers' experience. When they signed up with us, um, they didn't even have SMSF trust set up, right? And within 3 weeks, they set up the SMSF trust, roll over the fund, and in 3 weeks, we had a contract exchanged for a property for them. So, if you use the right people, like as Dhanush said, a right accountant, right mortgage broker, and buyer agent, you can get this done immediately. Like it's not a 3 months or 6 months um, uh, task. It's close to like 3 to 4 weeks if you use the right people. So our buyer easily settled in October. Right, we bought the property, we got a good settlement condition, and by October end we settled. So that was a really good success. Just wanted to share with you.
Yeah, absolutely. We've seen a lot of customers, right? It's all about the will of the individual, right? If you have the will, SMSF can be done in 2 to 3 weeks as well. There are certain external factors like the current industry fund, right? But again, we don't really need it to be rolled over to start the process. As long as the SMSF is set up, which is good enough, we can work on the finance. Whereas in the background, you can start working with your industry super fund simultaneously to roll over. It's again, you don't need the funds to be transferred to start looking for a property or start contacting buyer's agent. As long as it's set up, it usually takes about 24 to 48 hours. Speed is, everything in property game. So once the SMSF is set up, pre-approval can go into the system, whereas and we have the ecosystem, or we have the data, or all the information that a client needs, which I will pass it on to you guys as well, right, which you can send it to clients. Basically, which super fund, which contact numbers, what's the usual SLA that they have in terms of transferring their industry fund over to SMSF. So all the contact details that they need to email, so that, if a client does that, your industry fund usually comes over in about 2 to 3 weeks, right? Yeah. So,
Yeah, and to keep the process safe for our buyer, what we usually do is we give offer on the property as subject to finance,
yeah,
right? So subject to finance is, so we wait for the rollover to happen just in case something goes wrong. So as Dhanush said, 2 to 3 weeks is enough. So we start the process. It takes usually 1 or 2 weeks, and everything, all of these processes can be started in parallel.
absolutely. Yeah.
Right. Yeah, all of these can be started in parallel, but usually for a safety purpose, we will wait for subject to finance, like funds to be rolled over, so that we're 100% sure that we can settle on time.
100%. Yeah.
Yeah, I think we're
Yes,
right on time.
and lastly, on the screen, you would see that I have shared like WhatsApp QR code and the Facebook QR code. So we get and we post off-market properties on regular basis. It doesn't cost anything to join there. If you wish, you can join there and see what type of property we have, and it may be that something you really like and you want, because with off market mostly the competition is less, we are able to secure good deals.
Anita, is that something that you post regularly in terms of off-market
Yeah.
opportunities?
Yeah.
Yeah,
So
it's
Okay.
on our WhatsApp group, almost every day we have 4 to 5, 6, 7 off market properties on WhatsApp, and same properties we put on our Facebook as well. And many times we get buyers who say, okay, I exactly wanted that one in that region. Because, when people start seeing what type of off markets we have across Australia, that gives them confidence that, okay, these guys have off markets as well. Because we have networking with the agent throughout Australia.
Got you.
Any other question? If there is no questions from anyone, we can call off for the day. It was nice having everyone on the webinar today, and I hope we have added some value. Thank you.
Thank you
Good
so
night.
much.
Thanks.
Thank
Thanks.
you.
Bye.
Thank you.
Bye.